Hello, everybody. Welcome to another Finamize Live. Please introduce yourself in the chat. Let us know where in the world you are dialing in from. We're going to get started very soon indeed. Hi, everyone. Good evening in Europe, good afternoon, or even good morning across the States. Welcome to another Finamize Live. Uh, I'm Carl Hazley, VP of Content, Chief Analyst here at Finamize. Delighted to welcome you all to today's event, How to Generate Passive Income in 2025, with our partner, Phoenix Energy. Now, a bit of housekeeping. Please introduce yourself in the chat, get to know one another, let us know where in the world you are right now. Remember to switch to all attendees so that everyone can see your message, not just myself and our esteemed guest, Matt. Format, 15 minutes of a discussion between Matt and myself, and then we will open up to your questions. And on that, please use the Q&A box, not the chat box for questions. So in the Q&A box, lodge your question. If you see a question you desperately want answered or someone else has nabbed your question, upvote it, because when we get to that section, I'll be sorting the questions by the most popular and we'll work through them. All right, let's kick off. Over 100 of you here and rising. Fantastic. I'd love to thank our partner for the event this evening, this afternoon, this morning, Phoenix Energy, founded in 2019 with a focus on mineral rights and non-operated working interests. Has since diversified through domestic oil production to emerge as a serious producer in regions like North Dakota's Williston Basin. Phoenix leverages proprietary tech and a disruptive approach to financing in order to identify and acquire high-value cash-generating assets. The company's financing approach allows it to offer investors anywhere between 9 and 13% annual yield through corporate bonds. Now, to date, Phoenix has raised over $700 million from over 4,500 investors across the US, many of who are looking for alternatives that promise passive income. Therefore, our guest today is the best person to have on the topic of passive income. I'm delighted to welcome Matt Weiler, Managing Director of Capital Markets at Phoenix Energy. Matt, how are you?
Doing well. Thank you for having me. Coming to you live from Colorado. So I fall into that kind of limbo of afternoon or morning. It's 11 o'clock here in the morning in Colorado, and I appreciate being on the platform this afternoon or whatever time it is where you are.
Fantastic. So look, Matt has almost 30 years experience as both an investment banker and a C-level exec with 3 fast-growing public companies. He's been involved in over 100 debt and equity financings, party to over a dozen M&A transactions on both the buy and sell side. So, like I said, no one better for this topic. Now, when we think about building wealth, the stock market tends to come up first and foremost, and for good reason. But what also comes up is the somewhat model portfolio of stocks and bonds, whether that's 60% stocks, 40% bonds, what have you. And a lot of the investment conversation focuses on the stock segment. But today, I want to spend some time on bonds. And by doing so, we're going to share some insights that other investors simply aren't paying enough attention to, in our view. So with that, let's level set the 150 people in the audience here today. We'll start simple, but we'll ramp up pretty fast. Matt, let's get started. What are bonds, and why should we care about them as part of our investment mix?
Sure. From the 10,000 foot view, a bond is an investment security, an instrument that is issued by an issuer, ultimately to an investor. And typically, a bond is used to finance a project. And for that, an investor is going to get a rate of return, a coupon rate, as we used to call them. But a bond is a fixed income vehicle. Now, as an instrument from a risk and safety perspective, in the United States, a bondholder would get paid before a stockholder. And that is in a corporate setting, which I think is where we need to focus today, because the instruments that I deal in and where my expertise is largely in the corporate sector, rather than things like municipal bonds or government securities, et cetera. But ultimately, bonds are instruments that provide an alternative to, say, equities. And as part of that, they are oftentimes looked at as a cornerstone of your portfolio that can provide yield.
That's really helpful. Great setting the scene. Maybe just to draw out that parallel with stocks a little bit more. How do bonds work? And what I mean by that is, I guess, how do they work for an investor? If I'm a stockholder, I'm looking for capital appreciation, dividends. What's my return from a bond?
Sure. Well, effectively, we can break these into two different categories. You have bonds that are listed, those would be bonds that are traded on a secondary exchange like the New York Stock Exchange or the NASDAQ. And then you have bonds that are not listed in any sort of market setting. In the market-based environment, if you have a listed bond, there could be two forms of appreciation or income that you would be eyeing as an investor. One would be the actual income, which is the interest that you generate in the form of the yield or coupon. And the other, depending on market interest rates, could be playing around with the capital appreciation. Little known fact for kind of everyday retail investors is that bonds, from a principal perspective, work inversely to interest rates. So as rates in the market rise, the value of the principal value of a bond declines, and vice versa. Now, I deal primarily in private securities, and there's a trade-off. With a market-based bond, you have liquidity because you can buy and sell very easily and actively. But the trade-off there is now you're in a market, and a market has ebbs and flows, and so principal is subject to ups and downs.
Yep.
In the securities that I deal with, it's the exact same corporate bond, but it's not listed. So there's zero principal fluctuation. So our investors are only looking for the yield, but it doesn't have the same liquidity profile. So there are some nuances. This is often where we're educating clients or prospective clients about what is a bond and then how you might navigate within specific types of bonds they're in, so we can be helpful to the clients based on their needs or interests.
Fantastic. Really interesting. And we're going to get into the meat of that passive income play essentially in a moment. But I think maybe just to take a bit of a step back. So how should I be thinking about diversification when it comes to bonds? I mean, again, just to draw the parallel with stocks, I could be thinking about different industries, different geographies. How should I think about it with bonds? You've touched on, publicly traded and privately traded. What other elements should I be thinking about in that regard?
Well, I mean, the same consideration should go into evaluating a bond that would go into evaluating an individual stock. Things like the health of the issuer. If I'm buying a stock in a company, I'm going to want to make sure that they're a well put together organization that likely is going to appreciate. In a bond, I want to make sure that I'm dealing with a well put together organization that can pay me. So, right, we're looking at not only collecting our yield, but also getting our money back at the end in the form of a maturity. Now, so with that said, when we think of diversification, it's not unique to one type of security, but rather the construct of a portfolio. So now I might say, well, if I'm going to use a 60% stock, 40% bonds, or whatever allocation that you see fit, and that can change over time as we start to uh, digest a risk profile change, but you can even diversify within the bond component of your portfolio. Maybe you have some low risk bonds that are government securities, lower yield, but likely to have almost zero principal risk. But you might want to blend that with something like we offer, a more of a corporate yield opportunity where we're paying 9 to 13%. And if you build a construct of a portfolio that has different pieces, all with creditworthy issuers, you might find a blended rate of return that's substantially higher than you'd find, let's say, at a bank or in a money market or some of the more vanilla mainstream yield vehicles.
Absolutely. Okay, well, let's get into the meat a little bit here, right? People are here because they want to know how to generate passive income beyond the stock market. So let's get right into it. Using bonds and potentially, using Phoenix's bonds, how do you do that?
So we're in the energy industry and we do issue corporate bonds as instruments to finance the growth of our company. And so by proxy, I'm speaking about corporate bonds and specifically in this setting, the Phoenix Energy bonds. We've chosen not to list our securities on a secondary exchange. So our investors are largely those that, yes, want passive income, but they're also interested from a diversification standpoint, as you alluded to. They're going a step further. They're diversifying by pulling some of the money out of the markets altogether. So while they might have bonds that are in the markets, these are bonds that are outside of the markets altogether. And we would argue that that in and of itself is a diversification strategy, not having all of your money in the markets, regardless of what securities that you're in. So this is an off-market security. It's a nice way to generate passive income with no ambiguity, because since it's off market, your rate is fixed and locked in. We have the option of paying you monthly, so truly passive income, and there's no principal fluctuation. So in the United States, a lot of our investors look at this with a lot of similarities to a certificate of deposit at a bank, where you have a defined rate, a defined term, and with our business, since we're the issuer, there are also no fees.
Got you. Um, and maybe this might come up in the Q&A, but it's probably worth spending a bit of time just explaining that point on the principal and how, if you are holding a bond all the way to maturity, you know, credit issues aside, your principal should be returned in full. And although that's true for, listed bonds, uh, the way that pricing, that live pricing dynamic day in, day out plays out is that effectively you might feel as though you're not getting that back. Is that a fair way to describe that?
Sure. Like, let's just use a representative example. Corporate bonds in the United States are $1,000 each. That's what's called the face value. That's the value if you hold till maturity, as you alluded to, absent any solvency or credit issues. So if you're buying bonds in the market, if they're trading at a discount to $1,000, then obviously there's a component where people aren't as certain that ultimately it's going to mature at that value, or there could be some market influences. Whereas if it's trading at a premium, that would have the opposite connotation to an investor. A private security never has that fluctuation, so it's always trading at par or face value. So yes, the goal is that you're counting on that $1,000 per bond being made whole when your bonds mature, so that you can either redeem and not have any principal losses. And what you do from that point forward, whether it's rolling over and opening up a new term or moving and reallocating your capital, it is the expectation that bonds are largely safer instruments because they sit in front of stock in the capital stack. So they're always getting paid before stockholders.
Fantastic. Just a reminder to everyone, please use the question and answer boxes. If you see a question you like or your questions have been asked, upvote it. We will be getting to them very soon. I want to squeeze in one or two more before we come to everyone's questions. And Matt, you mentioned safety, and I guess given the macro landscape, given the geopolitical landscape being anyone's guess right now, in some regards at least, how should we think about bond investments, I guess, big picture, and also Phoenix bonds in the context of the macro, and maybe to put a finer question on it, what are the most important macro trends that you are looking out for, and what's the sensitivity of bonds?
Yeah.
Capital.
Well, I mean, again, we can break them into the two categories of listed and non-listed. So I think that everyone, generally speaking, would say we're in a softly declining rate environment. So listed bonds would have that inverse effect that I'm talking about. As rates decline, you could see some appreciation of the principal in bonds. From our standpoint, off-market bonds, this is always remains an income or fixed income type of play. Now we're in the energy sector in the United States, so actually there's no ambiguity as to the geopolitical landscape, because if I hear drill baby drill one more time, I hear it every hour on the hour. I'm in the oil business in Denver, Colorado, for crying out loud. But you know what? All tongue in cheek aside, that's not a bad thing, because we know where we stand. There's no unnecessary political headwinds. We have an administration that's supportive of our industry. And frankly, markets take care of markets, right? And in energy, oil prices is the thing that people tend to focus on. Well, oil prices will ebb and flow, but does that necessarily mean that there's a risk and safety issue with a company like us. No, we've navigated through the good, bad, and the ugly, and we have instruments like hedging, et cetera. But I think what we're really talking about here when we get into issuer specific question is doing your diligence, right? We've talked broadly about bonds. We've talked about market listed bonds. We've talked about private bonds. We've talked about energy briefly. There's only so much you can do in 15 minutes. Then I would say from that point, you really do your homework, do your research, engage either with your advisor or directly with an issuer like myself to explore further. What are the specific things that I should be thoughtful about in this investment,
Yep.
geopolitically or otherwise? And that's where we can dig in with someone at the client level and explore things less so from a presentation perspective and more how we could be a tactical piece of their portfolio.
Absolutely. And maybe just a quick tip for everyone watching and listening. If you do sit down with Matt or his team and ask questions, the first question I would ask is, where you sit on the cost curve and, what price of oil you need for your operations to work. So
Sure.
I'll give that one out. I'll give that one for free.
Yeah, let's do it. So, oil obviously is a worldwide commodity and it's trading around the clock. Right now, oil's dead even at 73 and change. So $73 USD. So I know we have people from around the world. 73 US dollars is where West Texas Intermediate oil is trading right now. Now, we are a low overhead shop. We've got 125 full-time employees across 5 offices. And at the project level, we can break even at $26 a barrel.
Wow.
Okay. So we have extremely low overhead. Now, with that said, we are obviously issuing corporate bonds to finance the growth of the company. And we have a lot of investors that want their money back at the end, not the least of which is myself. So we hedge our portfolio. And what that means for the broader audience is we put a layer of insulation called hedging, which is our industry's version of insurance, to put a buffer, if you will, on our exposure to oil price. So right now we're hedged at $66 and change a barrel for about half of our portfolio. We've been through COVID-19, folks.
Yeah.
Oil went through the worst year in world history during 2020 as a result of COVID. And it's that hedging, that insurance that allowed us never to have an investor loss. So our track record is flawless. Hedging is an instrument that we use to protect our capital and that of our investors. So while we will navigate through the ups and downs of oil, we do pay a premium to lock in a minimum level where we're willing to take exposure.
That's really helpful. Appreciate you sharing that, Matt. Thanks. Okay, I'm going to come to the questions. As a reminder, pop your question in the question and answer bucket and upvote the questions you're most keen to hear the answer to. Antonio, you are the most popular, so we're going to start with yours. Antonio asks, for people in the UK, in terms of bonds, it seems like they've gone down. I think he's talking about yields from a 5% return every quarter to around 3.25%. Would it be good to go into bonds based on these returns versus market returns we see today? Also in the UK, how can I buy bonds that provide me with monthly returns?
Mm-hmm. All right. So let's answer this in particular on the first question. I think you have to ask yourself why you're making the investment. It's separate and apart from bonds or stocks. What is the purpose by which I'm evaluating this investment? Is it for growth? Is it for income? Is it for the safe part of my portfolio, the risky, et cetera? So if you have an answer to that, that might guide your decision. If it's purely for yield, I don't know that I could get too excited about a 3 or 4% product. That's just my personal opinion. You might want to look at something alternative in the perhaps alternative landscape that could perhaps generate more yield than that. But if it's for safety and capital appreciation, you might be just fine in this landscape because as rates continue to decline, you should see your principal buoyed, if not rising, et cetera. I just don't think it's an attractive environment just for the pure yield at these types of rates. And you're probably going to see some continued softening as the markets tend to reflect those rates of return as influenced by the price of the bond. So you should always kind of see bonds trading in an effective market range, effectively based on their creditworthiness, at least. So in terms of the second question, how can you buy bonds to generate passive income in the UK? of course, I can't speak to the entire category of bonds, but I'd certainly welcome a discussion as to how our organization, Phoenix Energy, potentially could be helpful. We'd need to gather some individual information to see if this is something that you could participate in. But again, in the interest of the group's time here today, I'd take those discussions offline and welcome that correspondence.
Fantastic. Antonio, get in touch. We will help you follow up on that. Next question is from Stephen. $1 million question here. How do you know which country or company's bonds to trust?
Well, of course, we don't have time to really get into a full diligence overview, but the first thing I would say is make sure that the issuer is going through the proper regulatory channels. At a minimum, that there's legitimacy that's been validated. So that's step one, right? Do not entrust your capital. In the US, we have the Securities and Exchange Commission that has requirements for all issuers. So I would make sure that all of those boxes are checked. That's step one. Step two is evaluating the quality or credit worthiness of the underlying issuer. And if you don't come from a deep finance background, that's where some may rely on a financial advisor or a CPA or people with the issuer. Someone like myself who doesn't have a conflict of interest, I'll share with any prospective client what the risks are and how they might want to think about this type of security in their portfolio. And I don't have a conflict of interest in sharing the details about the underlying security because my economics are not based on that. They're based on the overall performance of the company. So anyways, everyone has their own kind of approach to investing and research, but I would first validate legitimacy, then dig into the specific company. And where you feel like you're over your skis on expertise, bring in an expert.
Fantastic. I think you've hit two birds with one stone there because you've hit Angelique's question as well, which was around how to analyze bonds to include in her portfolio.
Now, one thing on that, just real quickly, for those that are in the markets, a lot of bonds are covered by rating agencies. Now, personally, I would also do my own diligence, but you have the likes of Fitch, Moody's, and S&P that will oftentimes rate bonds AAA, A, B, B minus, et cetera. Now, in private securities like us, that's not the case typically. So you'd want to do your own research, but there is some third-party information available in bonds and corporate debt securities that you can use at least as an initial pass on the quality of the instrument.
That's a very generous statement considering their track record of being ahead of the curve or
Well, yeah, listen,
the case might be.
that's why I said I'd do my own diligence as well.
Yeah.
There's a line from Wall Street that says analysts don't know preferred stock from livestock, and they're probably not far off.
As an analyst in my former life, I must take issue with that.
Well, there's a reason you graduate beyond analyst.
That is true. That is true. Okay, Walter from his iPhone. Hopefully you're going to learn something here you can impress your boss with if you're listening from the office. Given that the bonds aren't listed, does it mean that you can't liquidate before the maturity date and you have to hold till maturity?
Excellent question, because there isn't a market you can sell into. But no, we are the market. So you can redeem your securities directly with us, the issuer. To be candid, with this offering, since it's a corporate financing, this is called primary issuance. So our bonds are not meant to be bought and sold. They're meant to be held like a CD full term. But no, you're not hostage to your capital. We understand life happens. And if you need to cash out, that's something that happens monthly with illnesses and taxes and things that will arise in people's lives. So we are the only market for the securities, but you don't have to hold full term.
And just to throw in Helen's question here, which is how long is the maturity of the bonds to get, between 9 and 13?
Yeah, we have very specific rates and terms. So when we say 9 to 13%, please don't confuse that to be a range. It is a 1-year bond at 9% and an 11-year bond at 13% and everywhere in between. So 3, 5, 7 years, 10, 11, 12%. So it's all defined by the term. And I would encourage everyone to reach out to me on specifics, just since we have a sizable audience here.
Fantastic. Okay, now, Alexi with an interesting question given the news flow over the last weeks and months even. What would be the benefit of buying bonds instead of crypto?
Wow, apples and oranges. You know what? Predictability, some sort of visibility on the outcome. Crypto, I take no issue with other investments. So I want to be clear. I don't think it's a great strategy to promote yourself by disparaging others. So crypto is wildly speculative. The risk reward profile is through the roof, but it in some ways could be objectively called gambling. And a bond is a very defined fixed income instrument. I think it's really comes down to your risk profile. I tend to see a lot of our investors between the ages of 50 and 90 in the bonds that we deal in. Whereas I know crypto investors are all over the map, but the risk tolerance of who we see versus what I perceive the risk tolerance to be of someone that's in crypto, I think is pretty far apart. We would be on the other end of the spectrum.
Interesting. Cool. I think a very balanced answer as well, actually. Um, okay. A couple, well, we've still got a fair bit of time, so a couple more. So B asks, what options are there outside the US? Is, for example, Phoenix Capital available in Europe?
Not yet, and it's not for lack of interest. It's there's international securities laws that have to be dealt with, which can be cost prohibitive unless you have considerable scale in that marketplace. So we have scale in the U.S. We manage nearly $800 million of investor capital. There are alternative marketplaces developing very robustly throughout Europe. Actually, the UK is really the UK and Israel are kind of the fintech hubs that we've seen a lot of alternatives popping out of. So you probably have a landscape that is similar to the US, maybe not quite the variety, but most US issuers in the alternative landscape, in the private placements of securities, are challenged based on their size to deal outside of North America. Now, we can take investments from non US citizens, but they have to have a US bank account.
Got you. Okay. That's a useful bit to know. So another question from Antonio, I think double clicking maybe on the risk element and the macro element. So
Yeah.
uh, he says, based on your experience, this is a big question. Do you think we'll see a market crash in February? Based on DeepSeek, it seems like the US has got the whole AI game wrong and they don't need to invest as much as other countries have to make the same products. Will the energy market be as interesting without that need of as much compute power?
Wow, that's deep.
Yeah.
First of all, I'm going to have to make an assumption. And when I say market crash, I'm going to assume that's the equity markets, not the oil market.
Nice.
So I haven't made my living speculating on the future of equities, or else I wouldn't be talking to you right now. But I think the market's a bit frothy. Yes, I mean that now it's like exclusively my personal opinion. Is there a compelling reason why the S&P is over 6,000? Not in my opinion. I think the market's gotten a little ahead of itself, but I don't know that the deep seek thing yesterday, kind of the knee jerk reaction. I'm not sure that I'm willing to stake my reputation on that being the harbinger or the canary in the coal mine.
Mm.
AI, machine learning, data centers, that's all here to stay. And it does require a considerable amount of power. Objectively, third parties have suggested that by the year 2050, our world will require double the energy that we're using today. And what no one on any news channel will tell you, but I'm happy to, is that we don't get to that point without all forms of energy. What politics does is it creates divisiveness. So in the US, you have people that believe in solar and wind, and those people hate oil people, and oil people hate solar and wind people. But that's not truly the case. We need all of it. We need oil, we need natural gas, we need solar, we need wind, and we need nuclear if we're going to have double the power that we're using today. I'm able to be objective about that, as are my partners. We're one form of energy. We happen to be a high margin business that allows us to pay higher yields. So it resonates with a lot of investors.
Fantastic. We're coming up on time, so I want to squeeze in one final question, which is just to, again, to call on your experience, almost 30 years in the industry. You've seen a lot as far as cycles go. You know, I guess part one, where do you think we are now? And I guess you've answered a little bit of that in terms of certainty in the energy industry, at least. And, with a 20-year, almost 30-year time horizon, what sort of, what two, three bits of advice could you give our members here today just to help set them up for success in bond investing and passive income generation?
If you're in the markets investing in bonds, be sensitive to interest rate cycles because they are cyclical, right? Ebbs and flows. And you don't want to be caught on the wrong side of that with an unsophisticated advisor that doesn't understand the inverse relationship between bonds and interest rates. So be cognizant of that if you're in the markets, because if we're talking in about 20 or 30 years, you will go through cycles. Don't be scared of that. That's an opportunity, right? That's an opportunity. If you can keep your pulse on interest rates, you can make money two ways, from the yield and the capital appreciation or deterioration. So you can double dip, if you will. From a longer term perspective and just criteria in general, don't chase yield. I know we offer a 13% product, but it's actually high quality. Don't buy a 22% bond because it's a bond and you think 22% is going to be stable. All right. In the market, that's indication that the credit worthiness is suspect. In the private markets, you have to do your own diligence. But the one thing I would say is cursory investors don't chase yield, buy high quality, do your research. And when you're not the person that is best to do that, then bring in a professional that can do the research for you.
Fantastic. Matt, we've got so many questions that we haven't managed to answer, and we could go on for another half hour, 45 minutes, but I'm afraid we have come up on time. Matt, thank you so much for your insights, your opinions, your views. I've learned a ton. I hope everyone else has as well. For everybody, before you click off, as you leave the event, a pop-up survey will appear on your screen. Please take 35 seconds to let us know what else you want to hear about at these sorts of events, and let us know what you thought of myself and Matt, mostly Matt, and give us any feedback you can. We're here to help you guys, and we love doing it. So thank you everyone for joining us. Look forward to seeing you at another event. And Matt, thanks again for all your time.
It was a pleasure. Nice to meet everyone. Thank you.
Cheers.